We were now getting into investing. That's what most people think of when they think of personal finance. That's the reason a lot of people want this class. That's a lot of people think of finance. It's in the market. So we're in the meat of it. As we've learned, there's a lot that's going on with finance in here that has to lead us up to this point. We're going to go over some basic principles. We're going to go over, how to look up stocks, etc. Some of that may be very much of a repeat for some of y'all, and some of y'all it may be brand new information. So I'll try to cover it without being too simple, but also make sure we cover it so that everyone has a grasp of it. Okay, so why would you or should you establish an investment program? That's kind of a loaded question. Are you ready to begin investing? Oh, sure, we're all ready. We all know it all. Well, you want to be sure that you have specific goals. Now, it's a little nerdy to tell you that you must write them and be specific and have them measurable. It's good to have that. It is not nerdy. It is very practical. Are you expecting this to grow till you retire? Are you wanting it to triple in 2 years? Are you wanting it, which might be unrealistic? Are you wanting it to double in 5 years? Are you trying to beat the basic rate of return of either the cost of living growth or of the CDs in the current market? Because, CDs are an investment also. So we're going to cover all of that. But trying to figure out what it is you want this money to do. Or you just want to make money and you like the thrill of it all. So that would be a measurable goal also. So ask yourself, how much do you need to satisfy your investment goals? Again, you need to double, triple, whatever. How much are you willing to risk? How much risk are you willing to absorb? The rule of thumb is always don't invest more than you can afford to lose, especially in the stock market. So if you have a low risk threshold, maybe don't go into high risk stocks, which sounds really elementary and sounds like it'll work. But I've seen people with a really low risk threshold get talked into going to something that sounds phenomenal and they're going to double their investment and everybody's been in it. And you could and you could not. So again, how much are you willing to assume and risk, and how much are you willing to lose if something should happen? What possible economic and other conditions could alter your investment goals? Right now, you hear some econ people, well, y'all may not listen to them like I do, but you hear some people out there forecasting, oh, we're going to have a stock market crash. And then you'll hear the same breath or the next day, they'll go, oh, the market's booming. There's no way you could lose. You need to invest. So somewhere between those two, I think, is where it falls. This market, I will tell you, is not the market I was trained on when I had my investments class at the university. Because there's a lot of personal issues that drive the stock market now. There's a lot of media that drives the stock market now. There's also, we were taught not to invest in a company that didn't have the assets to pay everyone off, because you look at their balance sheet like banks look at yours, and you would figure out how many shares do they have outstanding, how many shares do they hold, what's their current net worth, and if they went under today, you're looking at, can they pay me out? Can they pay me what this stock is worth? Bottom line, that's what you want. But I can tell you that most of the not most, some of the stocks that are out there that are high traders don't fit that parameter. And so, that there's a little more risk in that too. Is it just the stock of the hour or whatever? Also know that the world plays a part in this. Sometimes on the weekend when other markets are opening on Sunday night, you can hear those, if you're following it like I do. Again, you may not be, and if you aren't, that's fine. But you may start hearing, oh, rumbling. There's, the market in blah 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 started falling, and then you may start looking at our indices, and they are starting to open down. So all of us play a part with each other. We are a global market. It is no longer just us versus them. So you have to keep those things in mind when you're looking at that too. Establishing your goals, consider what your circumstances are and are they reasonable? If you're wanting to triple your money in 2 years, that may be unreasonable unless you are willing to sacrifice your living expenses now to set aside the most that you can set aside to then put it in the highest risk that you can, and know that hopefully it will do that, but you still may run a risk of it not doing that. So, and then are you willing to make sacrifices to meet those goals? Because we're only given so much money, and we have to pay for all these things out of it. So again, you've got to have money that's extra that you're looking at the stock market in, more than likely, because you've got to have cash to pay for bills and expenses and things that are coming up. You can't just have it all in the stock market. Something else to consider, do a little financial checkup. That sounds really fun, doesn't it? Just kind of look, are you spending more than you make regularly? You all have been working hard or have looked at the budget, B word, project. Look at that and say, do I have a lot left over every month? Do I have a minimum left over every month? Do I have a little bit left over every month? And figure out how much you have left over. Then maybe you can kind of gauge how much you could invest. I know there are apps out there, and I don't remember the names of them. I apologize, but there are some that you can, pay for your items with this app, and they round you up to the next dollar and put the difference between what you're paying for that item and the balance of that into like the stock market or a money market fund. That's a nice way to kind of test the market without having to worry about actual investments, because you can just say, instead of spending $1.98, I'm spending $2.02 went into the money market. So it kind of is an easy way to kind of test the water. So that might be something to look out too. But anyway, know where you're starting from. Know what your budget is. Look at your credit card debt. Make sure it's not overwhelming, because you want to be sure you can pay that off also. So you don't want to tie everything up in the stock market. If the economy should tank, and if you start then selling your cash to pay things off, would you have enough to pay everything off? Because that may happen too, that you'd have to pay your credit cards off too. Start an emergency fund. We talked about life throws all kinds of curveballs, and we talked about in health insurance, you might have to pay out of pocket expenses or deductibles, and you have this stash of money. Make sure you don't touch that stash of money, or if you do, it's in something guaranteed, only because if you need that $1,000 deductible, you got to have that $1,000. So, and that's what an emergency fund does too, is kind of set up an emergency fund. The book recommends, and most economists will recommend, having 3 to 6 months of living expenses set aside before you start investing in the stock market. That way, if you lose your job, your company goes under, whatever, you've got some living expenses, and then invest the difference. So it's not just, I have $2 left over, let's throw it all in the stock market kind of philosophy, because you want to be sure you can get at it if you need it. And then see if you have a line of credit. You could use that for cash. If you needed it, cash advance your credit card, which we said is not great, but you can use it in a pinch, those kind of things. So just know what your availability is. Economic factors, of course, the economy and economic factors play in everything that we do. I can't remember if I've told you or not, I did not like econ. It was one of those things that I was like, I will never use this. I'm a finance major. I don't need to know this stuff. And I use the economic principles I learned all the time. So much for me being smart when I was in college, but anyway, the economy and economic factors that are out of our control play a huge part in how we live, how things happen, and how we pay for things, how our money is, how the market works. All those things can work around that. So just kind of keeping up with, overall, you don't have to become an economist. You don't have to, get up and watch certain shows at 5 o'clock in the morning and, get your head on for the day, but just kind of keep up with what's the economy doing. What are the factors that are out there that could affect me? Is there anything I need to be aware of or ahead of that's coming down the pike, kind of thing that you can do. The nation has a business cycle as well as the individual companies. So if the nation's going through a growth period, more than likely everything else is going through a growth period, which means you're probably making more money. You're probably able to spend more money. You're able to buy more money. There's more money flowing in the whole system. If the nation starts girding its loins, to quote a movie quote, and starts trying to kind of rein things in, you may feel that punch too, because it trickles down. That part trickles down. The other part that they try to tell you that trickles down with, giving the bosses big raises and they'll put it all down to you. That doesn't work. But this will trickle down. So if a company if the nation starts um, experiencing some decline or some loss of businesses, or if you're following even in a foreign market, if the country, if they start calling bonds, if they start saying that they need to they need to pay money off, or their credit rating is low or something like that, that can affect that country, and it can affect all of us, because the nation's business cycle does cycle into our companies that we're following on the stock market. It could even affect our company that we're working for, and then that, of course, affects our personal finances also. Um, so how do you manage your money? Well, make sure you have an emergency fund. Know what you owe. Reduce your spending where you can. That's just good practical sense there. Again, I sound like your parents at times. I understand that. Notified credit card companies if you can't make payments. We've talked about that when we had the credit chapters. Monitor what your investment is and monitor what your retirement accounts are. If they're in things that are fluctuating or in things like that, I'm the nerd. I keep a spreadsheet. So I kind of keep up with what they are and just see how they're growing. If you're in something that's going up and down a lot, maybe track it a little more, maybe quarterly, maybe monthly, and just see if it's going on plan to where you mentally made your decision early on. I want this account to double or triple in X time. So, um, investment goals, of course, are going to ask us, are we willing to sacrifice purchases to provide for investments? Because again, we have a block of money. We only have so many things we can pay out. So to put money to start investing heavily into a company or a stock or a bond or something like that, we might have to give up something. And, we talked about maybe looking and seeing, could you give up a, large Diet Coke that's not bought at happy hour at Sonic, and put the cost of that aside one day a week and see what happens in a month, and then take that and then let that grow, and then have that after 6 months or a year, have that to invest. But you've made a sacrifice of purchases to get a little fund going. So, those are things we have to look at too. Can we control our spending? If the country started going bad, if you needed every cash that you had, if the market wasn't performing like you're living on right now, could you still live? And that's an important question to ask. A lot of times we grow with the economy. If the economy's booming, we're spending, we're going. If the economy's in debt, we're going in debt. And if those start reining in, we have to also start reining in. And if we're slow to do that and we're not ahead of that curve, we can get stuck out there in a lurch sometimes. And so we want to be sure to keep up with all that. Excuse me. Um, a lot of people don't start investing and or saving because they think, oh, it's just a small amount of money. I'm never going to get anywhere. It's not going to make anything. I might as well just keep it in my checking account. I understand that philosophy, but seriously, if you could just put $5 a week in a savings account and just not pay attention to it, just religiously put in $5 a week. If you look at that at the end of 6 months and the end of a year, you'd be surprised how much was in there and how much you saved. That makes it easier than to maybe put $10 a week in. You do have to start slow sometimes. We all think we'll start saving $5,000 a month. If we're not making $5,000 a month, that's an unrealistic attitude. So, you got to keep that in mind too. But knowing that anything saved is something earned. So just keep that in mind and just know that if you start small, it's like I'll tell you when we get to the retirement plan chapter. Do the minimum. Get in a retirement plan. Start saving. Anything that you can set aside is going to help you later on. So just know it doesn't have to be a lot. You can start small. Small sums grow over time. And of course, anything that you can have interest bearing or dividend bearing or something that's going to increase it, that helps you. If your company has a match savings program, or some banks will offer, a savings match program, if they do, take it. If you put in $5, they put in $5. Well, that's $10 automatically. That's the reason retirement plans work really well. I'll tell you when we get to that chapter. If you put in $5 and they match it with $5, again, that's $10 towards your retirement. I know it doesn't sound like enough, but when you start saving early, it can make a big difference. The rate of return that you make does make a difference. So looking for the best rate, knowing what your risk factors are, and trying to get the best rate that you can get for you, for your safety net. I always tell you, if you lay awake at night and can't sleep because you're worried about your investments, you're in the wrong thing. So get into something that's comfortable and know that any return on your money is a return on your money. So just keep that in mind. And then look for things that postpone taxes. We'll talk about retirement plans, IRAs. When we went through the tax session, there were things that you could take off the top that helped reduce your taxes. That helps you in the long run too. Plus, you might get a refund. You could maybe pocket the refund and invest it and save it. So you can see how that would kind of work hand in hand. But anything that we can postpone taxes paying to the IRS, again, not paying them, but just postponing paying them. We're looking for tax avoidance, not tax evasion. So anything that you can do that helps you avoid taxes now may help your income and may help your savings. So look at things like that that can help with that. This is just an example. If you look at how much you could save, just to kind of make you feel a little better about that, I don't have enough to save, etc. If you can save $2,400 a year, which would be $200 a month, and chose earning 3% interest, you'd have in 5 years $12,000, 20 years $48,000. If you could get 7%, there's three. That's if you had no interest. Sorry. Okay, if you could do 3% interest, help if I look at my own chart, doesn't it? If you could do 3% interest, that 12,000 becomes now 12,742. So you've already earned $742 in interest. By the time you get to 20 years and that magic of compound interest, even at 3%, you've put in 48,000. It's now worth 64,000. Now it hasn't doubled because we have that rule of 72 we could do, and that's not been enough to do that. But if you can get a higher rate of interest, look at where we're at. Instead of putting in 48,000 in 20 years, you've put it now is worth 98,000. That's almost $100,000 by putting $200 a month in for. I know it seems like an eternity, but 20 years goes quick. But it does kind of give you, and you can see how it helped even at the 12,000. If you put in 12,000 for 5 years, it becomes 13,000 if you can get a higher rate of interest. So that's the reason interest is important and plays a big part in that. Again, knowing your safety and risk, that's vital. It's important because we all have different risk levels and we're not all cut out for the same things. I don't have a high risk tolerance. I learned that very early on. So I'm pretty conservative in what I look at. Doesn't mean you have to be at all. I've had friends that have had high risk tolerances that have done superbly well. And it's very tempting to think, oh, I need to change that. But I'm not comfortable with that. So you have to go with what you're comfortable with. And just know you're earning yours, they're earning theirs, and don't compare the two. Um, if you're looking for safe investments with less risk, usually people have they categorize it. So they say usually those people have no financial training or investment background. That's not necessarily true because, like I said, I'm kind of in that conservative field. My deal, I think personally, is I'm working with people's retirement money. So I want to be sure when they retire that they have money to retire on. And I don't like to gamble with other people's money or mine. So that's the reason I kind of fall into that conservative. Older investors usually fall into that more conservative, less risk kind of thing. Lower income investors, when you only have 5,000 going in, you don't want to lose it all. I mean, that's a lot of money. Families with children, you've got expenses coming out, that's going to change. So you kind of get a little less risk there. And then employees that are worried in job losses. If you're in a speculative market that, jobs are being cut in your field or in your place kind of employment, you're a little less risky to throw your money out there and try to win big in the stock market. Of course, some people, that's the big incentive. They would do that, but that's that. So again, that kind of gives you the parameters of who would fall possibly into that less risk category. The people that fall into the higher speculative risk usually are younger. They usually have a higher income because they've got enough to live on, so it's kind of play money. Married couples that don't have children, sometimes they can be a little more risky because they don't necessarily have unexpected child expenses coming up. They've got their expenses pretty well taken care of. Investors, people that study the stock market, can be a little more risk taking. And then employees with secure jobs will do it too. Okay, so evaluating your risk tolerance. There is, I think, a quiz. If there's not, I'll open up a quiz that you can do if you want. If you don't have any idea what your risk tolerance is, extra credit. Don't worry about it. And you can there's some other quizzes out there that you can always take online too, just to see what your risk tolerance is. And it's kind of good to look at not only what your risk tolerance is for the stock market, but what your risk tolerance is for life. And so if you look at how do you feel adjust risk and all things, that kind of lets you know what your stock market risk probably is too, your investment risk. Calculating the rate of return, there's a basic way to do that. So let's say we have $64,000 in stock, or 6,400, if I could read correctly, that would help. And this is saying by its Procter and Gamble stocks, so they're assuming it's a blue chip. Blue chip just means that they are one of the top companies, and it doesn't mean that they're blue or that they have a certain goal or anything like that. It's just the top companies in the United States are considered blue chip companies because they've survived economic downturns and everything else. Let's say their stock pays $40 in dividends and the stock is worth 69.50 at the end of the year. How do I know what my rate of return is? Because it's not like it can say, well, you've earned 7% interest and this is where you're at. So if you're trying to kind of figure out, is the stock worthwhile for me, or what is, or a CD, you can look at, you invested 6,400, they're paying you $40 in dividends, and now it's worth 69.50. So you take the increase or decrease in value. So the increase was $550. Add that dividend, because that dividend is income and that's added to that rate of return. Because even though that was an increase in the stock price, you got cash for that. So that is a return of your money. So you want to keep that in mind too. So you add those two together and then divide them by the original price you paid. And if you do that, you end up with 9.2%. And you can run through that little formula there. But so that tells you that stock is making a 9% return. So that's what you would need to meet and or beat if you went into something else. So, what makes up risk factors? We talked about calculating risk and having to do that. Well, there's inflation risk. During high periods, during periods of high inflation, financial return, again, government things we can't control. High inflation, the financial return on investment may not keep pace with inflation. We talked about that the government and the economy tries to stay at 2%. Currently, it's at about 4%. Um, CDs can be 4 to 5%, so they're just barely keeping up. So if you can get a higher return in the stock market, that's great. If our inflation risk goes higher than 4% or 5%, that could make it tougher to try to keep up with that. So that's where that comes into play. There's also a risk factor of interest rate, and that means the value of the investment with a fixed rate of return decreases or increases overall as the economy increases and decreases. That doesn't mean your investment does, but that means you buy it today. We buy a 1 year CD and it's earning 5% interest. Tomorrow, that 1 year CD rate goes to 5.65. That's the risk we run, is that we don't get the higher rate. It could go to Tomorrow's rate could go to 4.75. Well, then we feel smug because we got the better rate for a year. So, there's that risk factor of when should I buy it? It's kind of like with stocks. If you've ever tried to, and when I took my investment class at the university, of course, you were supposed to buy low, sell high. And you sit there and you watch it, you watch it, you watch it, and you watch it, and then you go, is this when I buy or is tomorrow when I buy? And so trying to figure out when to buy it was always the thing. Same thing with CDs or something that's fixed. If you buy it today, will the rate change tomorrow? Will they make a change? So those things are important to keep up. Business failure risk. There's also a risk that what you're investing in could fail. And if it fails, that's lost money. So, if you're in a CD with a bank that's got FDIC insurance, which they all do, then that's safe as long as you didn't go over the limit of the FDIC coverage. But if you're in a stock market and the company goes under, again, like we talked about, looking to see if they had enough assets to pay off the stocks. If they don't, you may end up not having any stocks there, any gain, any loss, any value. Period. There's a market risk. Prices fluctuate. This market is very unpredictable because, like I said, there's a lot of emotional driving of this market. It's not all what the price is worth, what the price earns, all that stuff, because there's a lot of what I call overinflated stocks in the market, where if that company went under, there's not enough assets to cover their stock shares. So that's an overinflated stock. So there's a lot of that going on in the market, which means there's some really wonky behavior out there. Wonky is a term I would like to clarify. So you want to be sure of that. And then, of course, global risk. That's that thing we really can't control, because if China's market should crash, that would dramatically affect our market. If Luxembourg's market crashed, it probably wouldn't affect ours, but it might affect the European Union, which then could affect ours. So, all those things kind of play together because we invest in their market, they invest in our market, we buy their bonds, they buy our bonds. So, all those things kind of intertwine. So, that can make a big difference too. Um, Inflation has risen 2 years in a row, 7% from December 20 to December 21, and another 6.5% from 21 to 22. Now it has come down from those numbers, but this just kind of gives you an idea of what inflation can do. And we all saw and lived egg prices last year, I guess. But anyway, eggs in 2020, and this had to do with COVID. We had a huge issue with COVID. Number one, because we had supply chains interrupted, we had workers interrupted, we had um, farms interrupted. I mean, everybody was exposed to COVID. Everybody was worried about COVID, and things shut down. Things quit working. I mean, there was all these things. So that drove inflation up for sure for that, along with other things. But you look at eggs became $4 a dozen. Chicken went up about 20 cents. So that's not a big deal. But ground beef is a big thing right now. It's ridiculously expensive. So we're in an inflationary period now, but you can just kind of see what a difference that made to those prices even back then. Investment income. Those are things that we want to invest in to give us some kind of income in the future, or give us a return of our money, or give us a return on our money. And then they're what we're looking at to maybe live on. You might want to live on the interest that you're earning, or you might want to live on, something like that. But there are things out there you can do. The safest investments are considered something that's a predictable source of income if you're looking for it. Some stocks pay dividends quarterly. That would be an investment income. Some CDs pay interest quarterly or annually. That's a set income. Um, Securities by the U.S. government, bonds, etc., those pay interest quarterly or semi-annually. That's a set income. So that lets you know you've got some things like that. Higher potential incomes could be municipal bonds. Those are cities and governments that issue bonds, and they will probably have a rate they're paying, and they probably have a little more rate that they're paying, because if you're investing in a city bond, they're not looking at long term and 30 years, and usually they're looking for something that is, and they want you to invest in it, because we'll get into the bond chapter, but you are basically like the lender. You're giving them the cash to do that project for municipal bonds and corporate bonds both. And because of that, a lot of times they will offer you a higher rate of interest than you can find anywhere else, because they need your cash, because they want to use your cash to build or develop what it is they want to do. Preferred stocks usually pay a set income. They pay a set dividend scale, and they pay it very regularly. So they can be a higher rate of potential income also. Mutual funds may be, because they're conglomerates together, and you're looking at a interest account for that, or a dividend paying accounts for that, and they'll pay you those also. And real estate property, it can be a higher investment return and a higher cash. The problem, or not the problem, the thing to think about with investment property, unless you're owning a house and renting it out and that's your income, which that would be very methodical and set, and you would know you had that income coming in. If you're buying your house and then wanting it to appreciate, almost all the time they do, but to take in that appreciation, you have to sell them. So unless you're the landlord, you're going to have to sell that investment to get that cash. Investment growth means that it will increase in value. We can look at homes do that usually. Common stocks, you hope, do. Growth companies, a lot of times if you buy a growth company or a growth stock, they don't pay a lot of dividends. So they're banking on your return being the fact they grow and double or triple or do something like that. And some mutual funds and real estate also offer that, of course. Liquidity, having investment liquidity means you have the ability to buy or sell without affecting the investment's value. So if you say, buy a mutual fund and it doubles, well, then you can take some of that cash out and you're not affecting what your original investment was. But real estate is not considered a liquid investment, only because you have to be able to find an offer, have an acceptance, find somebody to buy it, have the cash processed, and it takes between 30 to 60 days to close on a house. The other things, stocks, bonds, mutual funds, CDs, if you need cash, you can surrender them and get the cash usually within 2 to 3 days. So those are considered more liquid. Super liquid investments are considered cash that you have, savings accounts, and money market funds usually fall into that category. Stocks tend to be a little less liquid, because there's a lag time between selling them and the closing date, um, and plus uh, they may have a loss or something that doesn't give you all the cash you need, but they're considered a little less liquid. So just to let you know how we work at that. We can look at doing a thing they call asset allocation. That helps diversify. So what you're doing is you're taking it's kind of like when we look at or lump of money coming in, if you have an investment, say you have $1,000 you're wanting to invest, do you put all that thousand in one thing, or do you want to split it out among many things? And you find asset allocations a lot of times in mutual funds pretty easily, but you might want to have a little bit in tech stocks. You might want to have a lot in foreign countries. You might want to have a little bit in American companies, and those give you that idea. And you can based on what your risk profile is, you can set up your own asset allocation, or if you're working with a broker, they'll work getting one for you. But basically, it's so that you have some diversification out there, and you put part of your assets into each of these fields, so that if one tanks, you don't have all your eggs in one basket, as the saying goes, but you don't have all your assets in one thing, and then you don't have anything. So if you have 10% in tech stocks and they took a dive, you've got 90% in whatever else you had. So that's what that plays. And here's a pie chart. We like pie charts in the finance world too. This gives you a pie a pie chart to look at. They just have a 11% in cash, they have 7% in bonds, and then they have 82% in stocks. So they've kind of buffered themselves. They've got some bonds. If bond rates you're doing good, you've got that. Cash is good, of course, always. And then stocks, you got a big chunk there, and that's looking for a young investor, because the younger you are, the more risk you typically usually want to take. So stocks are a good choice of that. There can be a pyramid in investment too, with low risk being the big base and high risk being the top point. And so, looking at the different things that would fall into those different categories, there's four. Level one, you want the best security you can have. You want that grounded, hold the pyramid up kind of attitude. Cash, CDs, money market funds, and government bonds. Level two, you want some income in there, but you also want safety. But so you're not really it's still pretty wide there. You can see it's not as wide as the base, but it's still pretty wide there. So, it's going to be securities, again, US securities, but it may be some corporate and municipal bonds. You kind of want to play a little bit with getting a little higher rate of return, because they're going to, use your cash quickly. Some income stocks, they're going to pay some income to you, and maybe some conservative mutual funds kind of make up that block. Then level three, you're looking at growth. If you're in a level three, you want growth stocks, growth mutual funds, rental property. You're looking for anything that's going to bring in money, and that's level three. And then level four is speculation. That's getting into commodities. That's getting into risk investment in high risk investments, speculative stocks. That's your buddy down the street that's got a thing going in his garage, and he thinks it's going to make him $1 million, and you invest in it. That's kind of a speculative stock, because you don't know if that's going to take off. You kind of believe in him, and it could take off, and you could make a ton of money, but it could not take off, and you don't make any money at all. So just kind of think of it as a pyramid, and from low risk to high risk, and how it builds on each other. Asset allocations can help reduce risk if you've got it split out, because the longer you're invested, the better your opportunity for returns. Plus, by not having everything in short term, you get some long term returns. Not having everything in something that doesn't grow one year, it helps you have the other part of it is growing. And then, of course, if there's a loss, it's not everything is lost, it's just that chunk that's lost that we talked about. Our age plays a factor in it. It typically, the younger we are, the higher risk we're willing to take. The older we are, the less risk we want to take, because we want that kind of guaranteed income, or we want our money to be there when we want it. And so it's there was an old saying that we still use in our business, that is, I want the return of my money, but I don't, I also want to know the return on my money. So, you want your money back. And so a lot of people, when they go into investments, if they put $1,000 in, they want the $1,000 back plus some. And so that's the return on your money, and it's a return of your money. But so sometimes you invest in something and you put $1,000 in and you get back $900. Well, you didn't get your money back. That wasn't the return of your money. That was just the return on your money. So you want both of those. Okay, so now what do we invest in? We've got all this knowledge. We know there's all these options out there. So what do we invest in? Well, we can, of course, have bank accounts, money market accounts, and CDs. Those are safe, stable. We know that. Corporate bond is like a loan to the corporation, as I mentioned about bonds. They need capital. They need to work. They need to do something. And that, sure, they could go to a bank and get a loan, but a lot of times they'll do a bond issue. And what they're doing there is giving you, the investor, a chance to participate and give them money. And they're going to pay you an amount for a set period of time to pay that bond off. and do get to be able to do their investment or their add-on or their building redo or whatever it is they're doing. Bondholders get periodic interest payments, and the principal is repaid at maturity date. So again, it's a return of your money. So if you put $1,000 in a bond and it's for 10 years, you're going to get back your $1,000 plus you've had interest for those 10 years that's been paid to you. So that's an important thing to keep in mind. Equity capital, that's people that need cash now to start up a business. Sometimes you're a stockholder and participate that. Sometimes it can just be that a buddy knows, hey, invest in my business and I'll, this should take off. But it's not required to pay you the money. So there's no guarantee that you get the return of your money. You just get the return on your money. And of course, some stocks will pay dividends, which is important. Some stocks will pay um, or they'll split shares if they get to a certain price. So there's ways that you can make some extra money without there being an actual interest payment or something like that. Dividends and splitting stock. Um, Common stocks. There's two types of stocks. There's common and preferred. Common stock is traded on the exchange. It's what most of us buy. Preferred stocks. The shares aren't traded on the exchange, and typically those are like for board members. Typically, I mean, you can always buy preferred stock. But the thing about preferred stock is because it's not on traded on the exchange, it's kind of like if you had a car, you need to sell your car, you have to find somebody who wants to buy your car. If you have those preferred shares, you can't just call up your broker and say, "Hey, I want to sell those." You have to. There has to be a buyer to buy your shares to sell them. So there's a little less flexibility there. Now, the preferred stocks will get paid dividends first. The preferred stocks get preferred treatment. There's some things out there that make it worthwhile, but again, you can't just call up your broker and or sign on and sell those unless somebody is out there willing to buy them. Mutual funds, most everybody that gets into the stock market enjoys and uses mutual funds because they give you a way to diversify without having to make those decisions. You can buy one that pays dividends, you can buy one that's high risk, you can buy one that's in tech, you can buy one that covers all of those areas. And so it allows you to diversify without having to consciously make those choices. And you can usually buy in at a smaller rate. If you're buying stocks and stocks are trading at $100 a share, you have to have $100 to buy one share. And if you had $100 for a mutual fund, you'd buy shares in that mutual fund, but they're usually rated a lot lower. And you've got $100 going in and have all this diversification. All of a sudden, you don't just have one share of stock. Real estate, of course, the goal is it increases in value, and so far it almost always has. There's been a few blips in the real estate market where prices have dropped. Just make sure that's not the time you sell. That would be the time to buy. Um, and then it increases in values, and eventually, of course, you sell it for a profit is the goal of all real estate ventures. But of course, there are no guarantees. Nationally, real estate has been increasing at about 4 to 6% every year. That's great. But again, there could be a decrease in that. So it's considered a long term investment. It's not a get rich quick scheme. And of course, always keep in mind location, location, location. And of course, a lot of people in Northwest Arkansas are getting into real estate ventures and buying property to rent out because we have a rental shortage here, and that's great. But I can tell you from living in Fayetteville as long as I have, we had a saturation point before, and I just worry that we may hit that saturation point again where we have too much real estate that's rental and not enough people to rent them. So, that's just something to keep in mind. Before you make a decision to buy any property, is it competitively priced? Do you feel like it's a good investment? Is there financing available? How much are the taxes? How much does the property need repairs? Are you buying an old home? I fell in love with the home. I may have told you this in the historic district. I wanted it so bad, but it needed repairs, and I knew that. And it was at a decent price for purchasing the house, but I'm not handy. So I was looking at the purchase price plus then having to hire somebody to do all the work, and I knew that would be way out of my budget by the time I got through with that. So, buying newer was definitely the thing for me. What are the conditions of the buildings and houses around it? You want to be you don't want to necessarily be the most expensive house in the neighborhood. You can be, but it means there's less room for growth usually. And you can be the cheapest house in the neighborhood as long as the neighborhood's in good shape. So finding that keeping up with what the neighborhood is. What are the planning commissions looking at? Is it going to be everything around you is going to be bulldozed for something? You have all this wide open space, but it's been sold to a developer. Just keep in mind that those things can make a difference in how much your real estate property will grow. And then why are the present people selling the property? People don't ask that question a lot. They just go, "Oh, great, great house, great location." Maybe ask why. Are they moving? Are they downsizing? Are they moving districts, school districts? Well, I thought this was a good school district. I mean, just kind of find out why, because there could be something that would be a red flag for you. There is a an investment option out there besides just buying property if you want to get into real estate called a REIT, or a real estate investment trust. And basically it works kind of like a mutual fund. You buy into it and you're buying into properties all over. They can be in certain localities, certain states, certain areas, certain types of property, etc. Kind of like a mutual fund would be. And so you can buy into that and buy shares in that, and then you're not responsible for filing fees, closing costs, inspection reports. Because if you buy rental property, you're responsible for all of that, and then you have to turn around and rent it out. So buying a real estate investment trust kind of saves you all that out of pocket expense and just lets you invest in real estate away from having to do that. Commodities are considered a high risk investment. Derivatives, metals and gemstones, coins and stamps. Options in the stock market. Sometimes they'll give you an option to purchase future shares at X price. That can be kind of risky. Antiques and collectibles. And you can see why those things fall into that category, because there's really not, I mean, you can collect coins and stamps, but unless there's a market to buy them, it doesn't really help you any, because you have them and on paper they say they're worth this, but if nobody's willing to buy them, they're not netting you anything. Antiques and collectibles are the same way. Uh, Gold coins they try to sell on TV late at night kind of fall into that too. Again, they say, "Oh, it's the safety. You'll have gold. You'll be blah blah blah." That's great, but if the market tanks, you have to be sure somebody's out there to buy gold coins, because there may not be. And you have to find a certain person to sell them to. So just keep in mind that there's nothing wrong with those. It's just that they're not going to be a high trading, high cash kind of thing. And there's people in all of those fields all the time. And if you enjoy it, that's worth a lot to you to do that. So that's where the price kind of the time frame and stuff outweigh it, because you're having fun with it. So, doesn't mean it's bad. Just means it's not going to probably be something. If you have a stamp collection and need $25,000 cash, and your stamp collection's worth 50, well, hopefully there's somebody right out there to buy it. But if not, you're stuck with stamps and or trying to find cash. So now what? Now we have to figure out our personal plan. So establish your goals, figure out how much you want to put in an investment, kind of figure out where you want it to grow to and how fast it needs to grow. List some investments that you want to evaluate and maybe watch them. If it's stocks, it's kind of hard because you think, "Oh gosh, they're lowest now, and I need to buy them now," and it could be you do. And then, of course, keep in mind the risk and potential return for each. You don't have to make a list, but just know that that enters into your calculation in your head. Um, Choose at least two different investments to get into, and then always evaluate your program. Is it working the way you want it? Is it doing what you need it to do? Is it providing the income and the growth that you need it to do? If it's not, maybe we need to change it. And so that's always kind of a good way. This is just a chart that the book has. I'm not going to go over each thing, but it just tells you what the safety is, what to look at for risk, what to look at, for liquidity, what to look at for growth. And you can see they all start out as like average, low, high, average. And so they're just kind of what we just talked about. So they kind of fit into just a chart if you want to look at it in a chart format. What's your role? Well, you get to evaluate your progress and the investments. You get to monitor them, and you need to keep accurate and current records. Now, most of the trading is done online, and so you don't have to have actual stock certificates, which definitely were issued at one point in time. Um, and if you had to have a stock certificate, you had to keep them safe. And if you had to have a stock certificate and you had to sell it, it was kind of like a car title. You had to sign it and sign the back to sell it, and then get it to either a brokerage house or mail it in to sell it. So It's a lot easier now that everything's done online and records are kept online because you don't have that alleviates the time delay too. Choose if you choose a stockbroker to help you or a financial planner to help you, choose them wisely. Um, Google them, ask friends, ask around. Keep your ears open at events. Those kind of things just to evaluate to see if they're good. Know that most financial planners and or stockbrokers are going to earn a commission. They may charge a fee, one or the other, but just see how it's charged. Is it going to hurt your financial planning that you're doing? Will that work fine? Does that factor in, etc.? Of course, the internet has got tons of things out there, and we'll get into those as we get into each of the individual investments you can get into. But Yahoo, Bing, Google all have that. There's, Wall Street Journal's online, all these things that you can look up stock prices, and it's very important to keep up with those things. There's business periodicals. The Wall Street Journal is still considered the gold standard, as it has been for a billion years. Um, the thing about the Wall Street Journal used to be is that it was printed on paper. So when you got the stock prices for the Wall Street Journal, they were out of date. I mean, basically, you were looking at yesterday's closing prices. That was the big thing. The Wall Street Journal printed out, after the markets closed the day before. They did mass printings of all the market accounts, and then they were in your mailbox or at your front door or at the mailbox by the next morning so that you could open the paper with your coffee and see what those stocks had closed at. So it made it for people that really follow the market, it gave them something to do. It is still a fount of research and information, so it's still very credible. And it's online now, too. If you get the print edition, it's still behind, but if it's online, you're getting current stock quotes. CNBC tells you market coverage, investment information, economic news, all those things you need to know while you're looking at investing. There's Investor Services, Standard and Poor's, Morningstar, and Value Line. All rate companies. Well, of course, they do on the Yahoo and the Google and the searches and stuff too. We'll compare the companies, tell you who's financially strong, who's having trouble, those kind of things. So all those things are important to keep up with. Um, these are internet sites: Bloomberg, Money, FINRA, Investor, Kiplinger. All those things are important, and they tell you what each one can provide for you. The Motley Fool, it's got a website, plus they've got a bunch of videos on investing and what to invest, how to invest and how to think through things. Quicken, of course, has got a website. You've got your program online. It can help you with investing. The SEC will let you know. You might look up a company if you've heard a rumor that a company is having financial trouble. You could probably find out on the SEC if they've issued some kind of warning to them or something along that line. And the Yahoo Finance thing is the thing I think I go to probably the most. And I don't have any stock in Yahoo, so it's not that I'm promoting that. But they give you all the stuff you need right there. They give you articles. They give you the stock prices, opening and closing, and all that. And we'll get into that. But you can see how that really does give you a one-shot place to find all that information out. Oh,